Hi, welcome to my video on cash flow budgets. Now in this video, be an active learner, take notes along the way. I'm going to try to talk today about some important topics, and I'm going to kind of really end up with a lot of information here on the board. But before I start writing, I just wanted to talk to you about the concept here, and that is something called a cash flow budget. Cash flow budgets are really the #1 management tool in finance for a business that I believe, and that's because businesses typically don't fail because they can't make a profit. Businesses typically don't fail because they can't get the assets they need. Those are problems that do exist. But businesses typically fail first because they run out of cash. They're not funded correctly. So to look at any business venture or to look at any budget of a business, a cash flow budget is a great tool. Now, cash flow budgets are best handled, probably in practical purposes, in a Microsoft Excel spreadsheet or something similar. That way you can have information that is very basic to your business, your cash flow budget. Things like how much cash is available when you start, how much investors are putting into the business and when they're putting it in, maybe when you're borrowing cash to operate, and then of course you've got your expenses, cash expenses that you have and cash income, and all of that's balanced based on prices and quantities and what you're selling and when you're selling it. So there's always like this resource page there, all the information is there. Things like we will start with blank cash on hand. In the first month of our operation, we will bring in $50,000 of investors. In the first month of our operations, we won't sell anything, no cash sales. But in the second month, we sell a small volume at this price, larger volume at this price. Maybe it's a seasonal business like we have in agriculture quite a bit, where we don't have income for a while. We have to actually grow the crop before we can harvest it. So we spend a lot of money up front, and then later we get our income. All of those pieces of information are typically listed in what we call a resource or basic information section of a spreadsheet. And they're all just values. And then the next tab gets opened, and that's actually the cash flow budget. And that just uses all of that information in formulas to calculate the results. Now, when you do a cash flow budget, and I'm going to talk about it here in this video, we also want to look at something called a net income or profit and loss statement, because that tells us the cash flow balances. We have money. We always need to have a net cash of something. You can't go to zero. In fact, most businesses have really kind of a threshold. They try to keep a certain amount of cash available every month or every quarter, whatever the period is. So once we know our cash flow balances, we have the money, then the next thing is this profitable? And all of that information we've projected helps us create the profit and loss. And then finally, after we have a profit and loss, is this a balanced balance sheet? And that makes sure everything is correct. So those are the concepts. And so handled in a spreadsheet is really how you would do that. But today what I'm going to do is just provide to you a structure and notes just on the concepts of how this information flows and how it's organized. So be an active learner, take notes with me, and I'm going to start off with, on my board here, cash flow details to my left, or over here to this side, I should say, to my right for you. This is going to be where the values are going to be listed and how a cash flow budget is structured. And then in the middle here, I'm going to look at, all right, now that we've got a cash flow and understand that, how does that create a net income statement or a profit and loss statement so we can talk about profit? Well, not everything comes over, so I want to lay out how that works. And then finally over here to the side, I'm going to look at a balance sheet and what flows to it so we can understand if our business even balances here. And those are the three things that I want to cover. Again, a lot of information. Be an active learner and take notes. So let's get started over here to the side here. You may do the same on your notes. Let's start with the cash flow budget. Kind of the whole focus of this video, really. Now, cash flow budgets are organized in periods of time. So I'm going to put in here periods of time. And periods of time, what I mean here is maybe monthly. I could mean here quarterly. So those are just some examples of how a cash flow budget is organized. Now, the reason it is organized that way is because that's the whole idea of seasonality. meaning that our business, let's say, starts in January, and if we're an agricultural producer, we're just preparing in January for possibly what will be harvested in the summer. So you have to kind of look at, what does the cash flow look like in January? Can we operate from January to February to March to April? We're spending money and not making any money. We better have some money available to get started. Then finally, when we actually start harvesting and selling, that's the idea of a cash flow budget. It's done in periods of time. So looking at the example structure of a cash flow budget, how does it work? Well, I'm going to start off and do everything monthly. So I'm going to put month 1, month 2, and month 3, and then kind of do some ... here, meaning it keeps going. Those are going to be probably in a spreadsheet, my column headings. Now, down these rows here, I'm going to start listing out what variables and what information should you already have. Remember, resource page that pulls this over. What would you already have here? And let's start with the first one. It's obvious is you need a beginning cash. So I'm going to put beginning cash right there. We're going to go ahead and have that as a value. And then I'm going to talk down through the column of month 1. What would it look like? And then that'll help us understand 2 and 3 and from there. So you're going to start with a beginning cash value that you have. That's going to be money that you have on hand to get this business going internally. But you might need to bring in other monies. And so these may have values or may not, depending on your plan. But I'm going to put in there investor money. So investors are going to help us bring in the money to our business that we might also use to get going. I'm also going to add in here that maybe you have a loan. And this would be, of course, a cash loan, of course. But a cash loan would be that we are bringing in money to borrow to get going. So that would kind of be something that might be available. And then, of course, finally, the goal is, and I'm going to give you an abbreviated cash flow budget. You could actually break these sections out and provide more detail, but the concepts are the same. What I begin with, what investors gave me, what cash loan borrowing did I do, and that's going to finally get added to. The whole goal is going to be that our business has cash sales, and there could be several rows of different cash sales. For example, if I was a custom meat processing company where I sold products, I might break the products out here and have different sales, like ground beef, like middle meat steak cuts, high-end steak cuts, maybe briskets and skirt steaks and other products I might want to detail out. So there could be lots of cash sales, but I'm going to do simple one here. And really, this is telling me all about my sources of cash. And so you're going to total all of these up to get to that. I'm going to kind of put a line there, and that totals up to give me sources of cash. So this is the amount of cash I have to use. Now, what would I do with this cash? Well, lots of things. I'm going to start over here, and there's a whole section, but I'm going to kind of list operating expenses, and I'm going to list those right there. So operating expenses are going to be very much like cash sales. You could have a lot of these. Like I could have feed and vet medicine and purchase of cattle, feeder cattle to actually feed out to sell. I could have diesel and fuel and fertilizer and chemicals and labor and those kind of expenses. That's all one thing called operating expenses, but you would, of course, have several listed here. All right, not only would we spend our money to operate, we might spend our money to pay back our loans payments that we have. Now, these loan payments are going to be meaning that we have a loan here, and that loan would be also similar to the loan up here if that existed. So our loan payments, but I'm not going to put a $sign there because loan payments need to be broken into the principal and they need to be broken into the interest that we have in those payments. Every time you make a loan payment, it's not just, it's one lump sum, but that one lump sum always is represented by part of that is paying back the principal of the loan, and part of that is paying back the interest on the loan. Those two together are the payment, but I need them broken apart because they actually flow through the rest of our financials a little bit differently. Now, we might have loans. We might also have down money. I should probably not say down with a dollar sign there. Let me put down money that we actually have to pay, because if we're borrowing money, we might actually be also bringing in new assets. Assets are what we need to operate our business. And so if we borrow money on a loan for assets, then we have principal and interest. But if we borrow money, we probably actually had to also put some money down to buy those assets. And so that's why I've kind of got that down money listed there. All right, so I've got my sources of cash. I might put a little box around that because it's kind of an important one. And then I go down through here and I have my operating expenses. I've got any loan payments I have to make, any down money that I have to pay. And so I'm going to end up coming here and calling all of these uses of cash. And the same idea exists that existed here. All of these operating expenses added together down through here create uses of cash. I'm going to put a little box around that. It would have a line underneath it too that separates it. And then finally you end up with the bottom line of this whole thing, which is called net cash flow. Kind of right here on the bottom of the board. It's kind of hard. But that is the last part here, net cash flow. And that will be what we have here for our cash flow. Now, how does that come about? Let me change colors here, see if I can help highlight this. Sources of cash are the plus of cash. So this is hopefully all the money we have available. This is where I'm going to use the money. And so that's called uses of cash. If you take the pluses and you take the minuses, and you put them together, you end up with a net cash flow. And we hope that this is always positive value. We hope. It needs to be. If it's not, then we have a problem. All right, well, net cash flow, that number right there for our first month actually is what starts the next month. And then this all gets totaled just like it was, and you end up with a net cash flow for that month. And that value transfers to be the beginning for here. And that is the idea of the cash flow budget. It's done by period. It has a summary of each period. The net cash flow from each period is what begins the next, and then you rock on from there all the way through. That gives you a chance to look at January and February and March, and do we have a positive cash flow? If we don't, then we better start with more money, we better get more investors, or maybe we haven't done an operating loan yet, but we need to get some more cash in here. If we do an operating loan, then that's going to cause us to end up with these payments. Maybe we paid too much money down to get started with the assets that we had to also buy. So maybe we put less money down, which means we have to pay more principal and interest, but that typically happens later. Down money happens usually right away. So that's the ways we can kind of manage this, but we got to get these numbers positive. Now, when we get done with our net cash flow, let me change colors a bit, because in a cash flow budget, I like to always have a total column. This total column is going to be, of course, the end after all of your months, let's say 12 months. Your total column just kind of helps make sure this thing is right, like you didn't have any mistakes. So one of the ways to do that is to do a total column at the very end. Because if you look at your bank balance in December, let's say, every statement that you get at your bank gives you a bank balance you have. The money you have in December is what's left over in December. But that was related to every prior month. So if you look at your ending balances as total, or you look at them each month and write those numbers down, in the very end, they have the same value. Totally, I end up with this much money. In the month of December, I ended up with this much money. It's the same value, or it should be. So to make sure you haven't made a mistake, it's good to add the total column and then pull over what is appropriate. Like, for example, in your total column, the money that you begin with is the most important value, because that is where you actually start. Now, every month you had values, right? But they all influenced from the previous month. So in a total column, you ignore all of those and you grab the very beginning cash you said you started with, and then you put it right there. Now, every other value for sources is just a total. So if you brought in investors, maybe not the first month and the second, but you brought them in the third and the fourth, then that would just total across there. The loans, if you borrowed money, that would total across there as well. The sales that you had would total across there as well. And then you end up with a total for sources of money. Now when you go through, and that's the same formula that you actually had here as well. Now it's not a total, but it's the same, I should write here, formula. So these are all totals, right, every month. That moves over to there, and that's the same formula that gives you the sources of money. So this is what the source of money was each month. This is the source of money you're looking at the whole year. All right, let's continue on down to the expenses. They would actually total across here, across all these months. Loan payments, principal and interest would total across all of these months that you had loan payments. And then money down would total across all of the months whenever you paid down. And then you end up with a total use of money, which is the same form you've had. Then when you get down to the very bottom, again, that is a positive, that is a negative. When you put those two together, that ends up with what we call net cash flow. And that is what we're looking for here. Now, the net cash flow of the last month and this month, they ought to be the same value. They should equal each other. All right, so that is the organization of the cash flow budget. Now, this cash flow budget is kind of one thing that we need to look at. But if we are running our business after we understand that our values are positive every month, overall cash flow is positive, that means that from these variables situation, we have a good business model. However, next thing someone's going to ask us is, what about profitability? How profitable are you? So all of this work that we've done in a spreadsheet would be a value. And then that would open up another spreadsheet or another tab and say, well, what about profitability? And we're going to use some of this information to come over there. So what parts are we going to use? Let's look at that. So we have what we call here a profit and loss statement. Now, profit and loss statement, it represents a set window of time, but sometimes it is by period. And so if you're going to look at a cash flow budget by period, by these months, you could do a profit and loss by the month. But in my case, I'm going to look at a profit and loss for the total. So I'm going to look at a total profit and loss, but it could be by the period. It's up to you. All right, now what information comes over to profit and loss? Well, it's a lot less than here. It's pretty simple, really. Really what we need is we just need items that would be called income. Now, income is going to be things that we make money on, it's the intent of our business. And so what over here is the intent of the business? Well, really, I'm just going to go over here to cash sales. I'm going to grab that total right there, and I'm going to bring that over here, and I'm going to just list it as the same, cash sales. And that's the total value right there. So I'm pulling that one number over here. Now, when I talk about income, that means that's the money we make. Beginning cash, investors, borrowing cash, those are all part of the sources of cash, but none of those, other than cash sales, is what our business is all about. So really, we just need probably that number. Now, once again, that could be several categories of sales, so you would bring them all over here as well. All right, so that is going to be our total income for our business. We could bring that all in. Now, the profit and loss now starts to say, well, what about expenses? Well, expenses are going to be things like, and we start looking at this, operating expenses. So I'm going to put a little box around that number, and I'm going to grab it and bring it over here. And that is going to be operating expenses. Dollar value right there. Now, the operating expenses, again, could be like cash sales. There could be a lot of those. Let's keep going down the line. The next thing I have here is a loan payment. Well, I've got it broke out to principal and interest, but I only have interest as an expense. The principal is just paying back that loan. So that's money that comes in from someone else to me, and I turn around and make a loan payment and it gives it back to them. There's no cost there to me. But the bank charges me for that, and they charge me interest for that. So interest is the other thing that goes into my expenses. All right, that's a number there. Now, as I go down through the rest of here, down money is kind of part of that loan. That really is part of my asset value, so that's not an expense to me. Uses of cash just totals all that up. Net cash has got its value, but over here in the P&L, that's all I need in the income statement. That's all I need. Now, expenses, there is something brand new I'm going to add here. I'm going to put new because we don't have it over here, and that is something called depreciation. Depreciation is that if you have assets that you bought, let's say a tractor for $50,000, that tractor is not going to be a $50,000 expense. It's not even listed here that way. It's borrowed, loan payments. So the value of that tractor is right there in our resource page. But it's not an expense to you right away. A $50,000 tractor is not an expense. However, it's not fair to have $50,000 of an asset sitting there and it not affect your P&L in some way. So what depreciation is a percentage of that, a portion of the $50,000. If that tractor is going to get used for 10 years, and if you have a $50,000 tractor, then you can say that's $5,000 a year. It should cause me to recognize as an expense. But that tractor, that $50,000 tractor used for 10 years has a salvage value. In other words, at the end of 10 years, it can get sold for, let's say, $10,000. So really now that's $40,000 that you have really in that, and you could divide that across 10 years. Depreciation is this idea that we have an asset that we've bought with money or down payment, however we got it. It's an asset we own, and it has a portion of it every year that ought to be expensed, and that's called depreciation. It's not in our cash flow anywhere. We have to kind of add it in. It's new, and that completes our total expenses. Again, be a lot more here, but just summary. So now total expenses and total income create profit or loss. We don't know which. Or you could also call this, by the way, net income. Sometimes it's called that. But that is going to be a value, and how is that value determined? Well, same way I did before here. Total income is a plus. Total expenses are a minus, and so if I bring these two together, that creates total profit, which gives us a profit line, bottom line. And again, we want our cash flow to be positive. We'd like this to be positive as well. However, to operate in your business, this has got to be positive. Cash flow's got to be positive. The P&L, it could be negative. You could lose money for a little bit, but you better understand that loss. And if you're doing a cash flow budget for year 1, you might want to look at year 2 and 3 and keep doing this to see if this ever gets positive. Because if it doesn't, you got some problems in your business structure. All right, the last, and I don't have much room here on my board, you probably don't either, but the next is going to be, let me change colors just for my board's sake here to keep it looking better. The next is going to be a balance sheet, and I'm going to kind of have to squeeze this in. Balance sheet. Now, a balance sheet is going to be the last financial statement, and balance sheets are really looking at what assets does our business have, and those assets have to be equal to either us borrowing the money, which is a liability, or equity, which is the other way we get money. This is the formula for the balance sheet, and this has to be true. And that's what we're trying to do, is we're trying to look at the cash flow, the P&L, and does all that flow over to a balance sheet where it does balance. That's what we got to do. All right, so what are the categories? Well, let's start off with assets. The asset category is going to be using some information, and I'm going to go grab those pieces. In fact, let me try to grab those pieces with, let's see, a different colored pen here. Let me go with this blue color. That's what I need to do here. All right, so assets, what are they? Well, in your cash flow budget, one thing that you did was look at cash balance. So that money that we have is our cash flow budget. In fact, this overall net cash flow, I'm going to grab that piece right there, and I'm going to carry it over here across my screen, and that is where that comes from. That net cash flow, it's the last month we had, that actually is what we end with, and that's what balance would be there. Now we also have assets. And that's a value there that we have. Now, if you look over in your cash flow budget, if you've got down money, if you've got loan payments on assets, then we have an asset value that must exist in our resource page. This is all of the transactions to get it, but that value has to be related to, come all the way across here, all the way to my sheet there, and that is that value there. So the asset value in our information page is what caused us to have down money and loan payments. So these things are factored in, so that value has to exist there. Now that asset value is going to have every year a depreciation value that's negative to it. In other words, it's a value that exists, but it comes off, and that comes from right here in our depreciation. So that's going to be where that value comes from, because these assets that we started with, they get paid off, but they don't stay that value forever. So our P&L actually plugged into depreciation, and that's where that's going to come from. So that gets taken away from it. That's why I've got brackets around it. All right, so that kind of puts us to the end of our assets. If you add all that up, then you get the total asset value. And again, depreciation gets pulled out of it, which came out of here. Now remember, this is new. We plugged this in. So the balance sheet's kind of trying to make sure that all this is right. And so if you don't add that in, then you come over here to your assets and they are overinflated, and so that would be a problem. But if you actually correctly adjust for them here, you want to make sure you adjust for them there as well, and that's kind of what checks our work. So that's total assets. That's what we have here as our value. Now, what's the next section of our balance sheet? And that is going to be the liabilities that we have in our business. So this is the items that we owe money on, these debts. Now, we started off over here with a loan that we talked about. In fact, I got the loan mentioned in a couple of places. I'm going to go over here and grab this loan, or if it's an operating loan, that loan too. But those two loans, those values come all the way over to here, and that is going to be our loan balance. Now, the loan balance that we have also has to take out the principal payments that we have made, because those had paid down the loan. So we started out with a $100,000 operating loan, but along the way we have made principal payments. So I'm going to grab that principal payment and I'm going to bring that over here. These lines are going to get a little bit messy for us, but that's where that comes from. And so this would be our net loan value that we have, and that is going to be our liabilities. Now you might have other liabilities, but that's going to be that there. Now the last section is called equity. Now equity is the net of lots of things, and the first one and the biggest one is equity is to make sure that we realize it's divided into two sections. The first section is going to be just our net income. So we have this whole value here, this net income that we calculated, right? That number right there, that's what goes there. And so that's going to be your net income. Now, if you have a business that operates over lots of years, that is accumulated net income. That's called retained earnings. But that's going to be the first part of our equity. Now, the second part of our equity is going to be any investor money that we have. And if I come over here and look at investor money, then that is going to be that value right there, and that is going to again transfer over to be that number right there, and those would be the ways we can look at equity, and that's a total. Now remember, with your balance sheet, and I talked about it before, that the assets that we have, these total assets, they must equal our liabilities plus our equity. And if these balance, if the assets equals liabilities plus equity, then overall our balance sheet balances. If the balance sheet balances, that then gives us confidence that that's the right profit and loss. If that's the right profit and loss, then that gives us confidence that our cash flow is covering everything it needs to. So when you come back and look at your cash flow, really everything flowed over. For example, your beginning cash and all of its results are the net values here, and that's our cash balance. Investors, if they came into the picture, they are part of equity. If we had any loans, those loans are all part of our liabilities. And if we had sales, that's part of our income. If we had expenses, that's part of our income. The interest expense is part of our expenses. I say income, net income statement. So all of those get factored into here. So individually, these are all part of this, but this flows over to the balance sheet as well. So everything done here, even our brand new item called depreciation, they all get factored into the balance sheet, which is why that's an important step to make. All right, hopefully this video gives you lots of knowledge about the structure of a cash flow budget, how that structure relates to a profit and loss and a balance sheet, and how all of these three together are important tools to look at business management. Remember the resource page, the basic information that told us about loans and beginning cash and sales and how those sales happen, volumes high, volumes low, expenses, all of this, decisions on borrowing, all of these are separate resource pieces of information that once you have this all laid out in a spreadsheet, you can say, all right, let's start changing our decisions. What would happen if we do this or this? As soon as you make that change in a spreadsheet, if you've got your formulas linked right, that's going to give you new cash flows, that's going to give you new P&L, that's going to give you a new balance sheet, and then you can kind of say, hey, that change is a good idea or a bad idea, and here's why. It affected profit this way. It actually caused our asset values to fall, and we don't want to do that. We want to keep growing asset or keep growing equity. And so you end up looking at what impacts the decisions make. But a cash flow budget is an important business tool. Number one reason why businesses fail is cash poor. And so we want to figure out how do we get that done. But once you get yourself cash flowed, well, is that still profitable? And maybe it's not. You borrowed too much money. Interest is too high. Depreciation is too high. You need to use older assets, not buy new stuff. So it really depends on the structure. But this video, again, is just talking about exactly the structure of a cash flow, a P&L, and a balance sheet, and how they interact amongst each other. All right, hopefully you've got some notes that help you remember this. Again, be an active learner, take notes, stop this video, start it over, help yourself by documenting what you're learned here on your own efforts in your own work. And that'll help you better retain and understand the process. And then when you go to the spreadsheet, hopefully you can connect that to actually doing that work there. Thanks.